You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Basically, you look at the silver price. I mean, I think silver stocks are probably the best opportunity for 2024, because if gold stocks are unloved, silver stocks are just hated.
You are listening to MSE. I'm Bill Powers, and in today's show, you're going to hear from a 20-year veteran of the junior gold stock market, David Erfle. Welcome back onto the show. Your website is juniorminerjunkiewithY.com. You've been at this a while. It's been over a month since we last spoke. Before we talk about the gold price in 2024, did you make any changes in your portfolio in December?
Yeah, I mean, we had that great interview with Haya Dwan of Asino. That was a big win for myself and my subscribers. It was a JMJ top 10 company, and I had hopes that it would be acquired before then. And of course, we talked about how we were hoping that they would be able to spin out those properties so Haya could do it again. But it sounds like it would have been a deal breaker, and he wanted to take a break for a while, and I kind of don't really blame him the way the market is. So, we took that win and we sold it the next day, and we placed the proceeds into two other juniors on my watch list. So what I do is I have a JMJ watch list of 20 companies that are pre-vetted by myself, and I know them very well. And I've had conversations with the management teams, and the two companies that I got into after I sold the Asino shares. I had meetings with both management teams at Beaver Creek, and then I had follow-up meetings with them. And they're both stocks, I think, that have huge potential. And, they're great entry points because, fortunately, when Asino did make that deal, it was, at the end of tax loss selling. So it was a great time to shift the money into a couple juniors. So basically sold one junior for really nice gains, and had placed the capital, the investment capital and the gains into two other companies. So now the JMJ portfolio has 20 solid juniors going into 2024. I also had some cash left over to average down on a few that I was down on. That's what's great about this bear market is you get into these things. I've been getting into these companies that I'm holding have been averaging down on them. And, when I first took initial positions, I thought to myself, wow, I'm getting these things really cheap, and they just continue to go lower. And, as the gold price continues to try to make a floor at $2,000 or get above $2,000 at first, now it's trying to make a floor at 2,000. Yet, people don't want to know about gold stocks. It's amazing. You going into 2024, we had the Dow, the NASDAQ, the S&P all close at or near their all-time highs. And you had investor sentiment was off the charts bullish. Yet you had the gold price doing the same thing. And investor sentiment in gold stocks is off the charts bearish, while the gold stocks in relation to the gold price have never been cheaper. So that's an opportunity. And, it's been frustrating, but at the same time, it's very exciting because we know that the biggest booms in the mining sector have come from busts in equities. And this 13-year bull market in stocks is in the bust phase. And there's signs all around. And, and basically the Fed came out and said as much pretty much in their last meeting. They surprised everybody and put out basically a rate cut timeline on their dot plot, and that surprised a lot of people. And it's surprised me as well. And what do they see? They see that I think they see that the U.S. economy is going into recession, probably either late in the first half of the year or early second half of the year. They know that their interest rate hiking policy, the most aggressive interest rate hiking policy in 22 years, the effects of that aren't felt on the market until 12 to 18 months later. I mean, we had the same thing kind of happen at the end of the dot-com bubble at the turn of the century. The dot-com bubble started to roll over, and then the very first, I think that was the first trading day of 2001, January 3rd, 2001, Greenspan came out with an emergency meeting with a 50 basis point emergency rate cut. And guess what? That started a 10-year bull market in the mining sector. And I think that there's a setup right now is very similar to that happening again. I really believe that could happen again once the, because the Fed is, let's face it, the Fed is reactive, not proactive, right? I mean, they don't cut rates expecting something bad to happen. They cut rates after something bad has happened. So, once they do that, that will signify that, that generalist investors say, hey, I better get defensive here. And this, as you know, this sector is so tiny, it doesn't take much for them to start piling into these things for them to really take off. And that's what's happened in the past so many times. I've been in this sector 20 years and I've experienced it myself. And I expect to experience it again.
David, with that bullish of an outlook for 2024 for gold, when you see a geopolitical event and gold spikes 80, 90 bucks in a day on a geopolitical event, would you ever consider just taking those profits and some of your miners then? Or do you consider like a burst like that, which historically, we see retraced and fall back down prior to the crisis event? Do you think it's different this year, that a crisis, it could be like turbocharging that keeps going, or do you expect those pullbacks? How would you play that?
Well, it depends on when it happens and what portion of the cycle the mining sector's in when it happens. Because I think we're at the bottom of a mining cycle right now. And, if you take, in the comparison's sake, the late 70s, right? You had a gold price run from a little over $100 to $400 in 5 years. And then I think it was just the last month or so of 1979, the gold price went from $400 to parabolically peak at $850 in January of 1980 when Russia rolled into Afghanistan. That was a geopolitical trigger of a blow off top. Now, in the situation we have now is, we've got 2 billion citizens of the world are going to be going to the polls in 2024, beginning with Taiwan here in a couple of weeks. And we know what's at stake in Taiwan as far as China is concerned. So, and at the same time, we've got a gold price that has been building a 3.5-year floor below 2000. Well, 13-year, 2000 has been resistance for 13 years, but it's been building a floor below 2000 for the past 3.5 years. And if you take an inflation adjusted high in the gold price, that's around $3,000, which we're not even close to yet. So, if you take a look at the mining sector, it's completely bombed out. I mean, there's, nobody cares about gold stocks. I mean, it's at all. So, I mean, I don't see a risk of having a geopolitical event right now causing a blow off top in the gold price or gold stock, especially in gold stocks that are trading at, like I said, they're at all-time lows in relation to a gold price that's about to break out.
And so would you be levered up a little more on silver at this point too? If you think gold's going to run, silver usually runs with it?
Yeah, and I mentioned that, in my very long-winded piece at the end of the year. Basically, you look at the silver price. I mean, I think silver stocks are probably the best opportunity for 2024, because if gold stocks are unloved, silver stocks are just hated. Nobody wants to be in silver stocks. So first of all, there's only a handful of them that are worth being in, but it's silver stocks that give you the biggest leverage whenever there's a huge upleg in the gold price, and then the silver price eventually follows. And if you take a look at the silver price, I mean, it's at less than $25. It's less than half of what its 1980 high was. And if you adjust its $50 1980 high for inflation, it should be around $150 and $200 even, maybe. I don't even know what the inflation adjusted high for silver is, but I know it's a lot higher than $50. And yet you've got a gold price that's 2.5 times its 1980 peak. And if you take a look at silver juniors, the barometer is the SILJ ETF. That recently hit, in relation to the silver price, the 2016 bombed out low. So if you take a look at the GDX and the GDXJ, these are mining indexes, right? They've been in a bull market, believe it or not, since the beginning of 2016. They've made higher highs and higher lows. But the juniors are a bit a whole different animal. They continue to get sold off, creating this opportunity. A lot of people get frustrated and they give up and they sell for tax loss and they don't come back. Well, this is the environment that you make money in this sector. I mean, you have to be a buyer in environments like this to make money in this sector. If you wait till it takes off and you start chasing things, then it's more difficult to hold, once there's corrections, because you've already bought after they've taken off. So, it's really difficult to do, but that's the way you make money in this sector. And that's the way I've made money in this sector for the past 20 years. You have to go through these bear markets. You have to literally grin and bear it, because this and buy these fishing lines and accumulate these stocks when nobody wants them, because you're going to be selling the rhino horns later for 2, 3, 4 times your money. You take some off the table, let the rest ride, and you got a free position. So I honestly believe that's coming here in 2024. I just don't know when, but I tell you what, it's probably going to coincide with the stock market starting to sell off. And it'll coincide with the stock market starting to sell off and investment capital finally coming into gold stocks, because it's investment the demand that really drives the prices of gold and silver, and especially the gold and silver equities.
Dave, there's a familiar proverb that says it's better to be taught to fish than to be given a fish. And so in your newsletter, you teach people how to research and go through the decision-making process before you come to a conclusion. You're not just giving them the pick, but you're bringing them through that thought process. I bring that up to say, when you mentioned you sold Osino and you went into 2 other stocks, those 2 stocks were kind of primed because you had already met with management. You said they were on your watch list. So my question is, when you go through that initial due diligence, they make it to your watch list, do you do any more due diligence before you pull the trigger to buy those kind of unexpectedly, because you didn't expect to sell Osino when you did? What is your secondary due diligence at that point? Or did you not even need to call management at that point because you were on top of it?
Yeah, I didn't, because like I said, I was expecting a mid-tier to come along and purchase Osino. So I had groomed these 2 companies before. Like I said, I spoke with both management teams at Beaver Creek, which was in mid-September. And I did have follow-up meetings with them, but I was convinced that these were the 2 stocks that were the best 2 stocks on my watch list to get into. If we were fortunate enough to get an Osino buyout before the end of the year, and it happened right before the end of the year. So, I mean, that's what you do. I mean, you have to constantly be doing due diligence, not only on what you own, but what you want to own. I mean, I've watched stocks for years before I took positions, and then ended up getting, 5-10 times gains on them. There's one stock that I really liked when they IPO'd. It was trading at $25, and I started accumulating it when it got down below $5. So, you follow along with management, you follow along with companies, you follow along with their progress or lack of progress, and they fall off. I've had companies fall off my watch list because, they weren't doing things that I would do if I were them, or they didn't get the proper management team to come in and helm the ship, because that's the big one right there. You have to get the proper management team that's got the track record of success. They've got that access to capital. Because right now, you've still got all this time to basically put your miner CEO hat on and say, okay, if I was going to go out and look for a company to add to my stable of mines, which company would I be buying? because that's what you want to look at right now. You don't want to mess with anything small. You don't want to mess with anything that doesn't have, that's not inside of a district scale size land package, that doesn't have blue sky potential. Or even you don't want to invest in a company that's over drilling a project either, because you want them to spend enough capital to show proof of concept that they've got something that a major wants. You don't want them over drilling it to what a major is going to eventually do and say, look, we spent all this money, and it's really hurt our shareholders because we've had too much dilution in drilling this property. Here it is. Will you buy it from us? No, you want to have a smart management team that knows when to raise money, how much to raise, from whom, the right shareholders in the stock, and drilling out enough to where they're showing a proof of concept to a major to eventually buy that stock.
And Gold Standard Ventures from the previous cycle would be an example, right, of a stock that was over drilled.
Exactly. And I got into that one late, and I actually got into it a little early, even though I thought it was late. And the funny story on that one was it got bought out a little less than our entry cost from Orla Mining. And Orla Mining at the time was overvalued, but they're very good operators, good mine builders. So I told my subscribers I was going to hold on to it until it got up to my entry point. I didn't want to lose money on it. That's what I did. So I ended up getting out of Gold Standard Ventures at basically a wash. So, I mean, these things happen, but you have to have a level head when they do, and you always have to have an exit point, in whatever happens with a stock. You don't lose your head and say, oh, I hate this deal, I'm selling the stock. You sit back and, okay, this is what I'm going to do to try to recoup my money, and then sell it and put it into something else.
Dave, back in 2016, when I was cutting my teeth on junior mining stocks, I had Explor Cos that went 3 to 4 times just because silver went from $14 to $21. So the Explor Cos move last, the Franco Nevadas, the Newmonts, they move first. We all know that. And then eventually the Explor Cos perk up, and many of them can go threefold on no discovery, but just because the commodity price is higher. I bring that up to say, if gold is going to run this year, you're not heavily weighted in Explor Cos right now. What's going to be the trigger for David Erfle to go more into Explor Cos?
Yeah, I've avoided Explor Cos for the past couple of years. You see, the last few times we've had this turn in the market that's gone from overly bearish, extreme black bearishness to newly bullish. We get that pop, we get that switch going on, and it affects everything, right? Even the bad companies go, even the dogs go up, right? I don't think that's going to happen this time. And I'll tell you why. I mean, the big reason is capital's not cheap anymore. Ever since I've been in this sector, capital's been cheap. And it's not cheap anymore. And they're not doling it out to just anybody anymore. They're only the companies that deserve to get financed are getting financed. And a lot of these companies, we've talked about it before, they need to go away, or they need to merge with other Explor Cos that have access to capital that can build their projects. But as far as getting back into earlier stage Explor Cos is concerned, I'm going to have to be convinced that the market is convinced that gold has a strong $2,000 floor. And I think that's going to happen at some point this year. Gold is consolidating its gains above 2,000 now. I think there's a good chance that it might dip below 2,000, maybe the 1980, 2,000 range before finally bottoming. I think that's a very real possibility. So, you still got plenty of time to accumulate the right companies, because you want to be in the right companies when that switch gets flipped.
And do you wait if it's a company with a good project, but they're not capitalized because of how tough the last few years are? Do you wait till they're capitalized, or do you buy them in advance of maybe a little marketing to get the share price up and then
that's
raise
a great
the money?
question. I mean, you that's when you have that one-on-one meeting with them, and you say, you know what, the market knows you need to raise money. You need to raise money. Do you have any options besides dilution? Because that's what a lot of these companies are looking at. They have other options. You know, they could spin out a royalty. You know, there's plenty of other ways. A lot of companies are divesting non-core assets. We had a few recently that have done that. This is what needs to happen. You know, they're concentrating on de-risking this project, but they've got these other assets. So they're selling them, and they're maintaining either some shares of the company that's bought them, or they're maintaining an SR to still have exposure to that property. But this is what they need to do. They need to find other ways to raise capital other than dilution, and a lot of them are doing that. So you call up the company and you grill them. You say, look, you're down to less than 6 months of cash in the treasury. What do you plan to do to raise money? And then if you've attracted enough investors, are you going to have to attach a full warrant? Are you going to have to attach a half warrant? Hopefully the reason why you're interested in the company in the first place is because it's got an attractive project. It's got an attractive project. They can probably raise money without a warrant. So, you ask all these things, you see where their share price is. If their share price is trading at multi-year lows and they need to raise money, that's not good. So, and of course, if you're looking at these companies with these great management teams, then they shouldn't be in that position anyway, because, a good management team never has less than $10 million in the bank. And they usually raise at a point where it upsets people and they think they shouldn't, but it always turns out to be a good thing they did. And that happened a lot in 2023. Coming into the fourth quarter, a lot of these companies they know that they didn't need money at the time, but the financing became available to them. And you never turn down financing, especially in a bear market. So, at the time, it upset some investors that they took so much, but come toward the end of the year, it was a good thing they did.
Yeah. David's website is juniorminerjunkiewithy.com. Go over there, learn more about his subscription service if you haven't heard of it already. He also has a free weekly editorial that he'll send you on Friday evenings. You can sign up for his free list there as well. David, always appreciate your insights, and we'll touch base with you in about 30 days.
Thanks a lot, Bill. Always great talking to you, and Happy New Year, everyone.